Good. Thank you everyone for joining us for ERS Live today. We're going to get started in a moment, but for those of you who don't know, ERS Live is a moment for us to, our annual moment to reflect on the year and tell you a little bit about how the year's gone from our side, but also a moment for us to also talk about what the roadmap looks like for 2024 and what we've got planned. So I know we've actually got quite a few hundred people online, so thank you for joining us, and also thank you for all those who braved the train strikes to get here. I know it's not easy for everyone. We should have plenty of time for questions, so if you've got any questions in the room, hang on to them because we'll get to them at the end. Hopefully there will be one or two, and if you use the question chat function online, then we'll get to those. We'll get to those at the end too. So quickly onto the agenda. Here we go. So in a moment, Martin's going to get up and talk a little bit about 2023 and some insights and views from our side in what has been a pretty disruptive and challenging year, I think, for everyone. We'll also have a view on what we think is happening in 2024. Alex and Scott will then talk about our e-trade investments and our digital investments through 2024, so you get a view of some of our roadmap. Then Annie will then talk about our prestige products and distribution channels before passing over to Chris, who's going to talk about ERS fleet, and there'll be a bit of focus in there around it's really key that we drive efficient trading with you in 2024. And then we'll finish up with me, who looks after new business for ERS, who will talk a little bit about how we can help and support you in what has been a pretty disruptive and dislocated market through 2023, and potentially is likely to be similar in the early part of 24. So before we get to that, some of you will know that ERS is part of a wider group called the IQ Group, alongside a syndicate called IQ. IQ is a property and specialty insurer and reinsurer at Lloyd's. Together we write about $1.3 billion of premium, and we've got 775 employees, and that makes us one of the fastest growing managing agencies at Lloyd's, which we're really, really proud of. And you might think, what on earth brings together a motor-only, broker-only syndicate in the UK with a global reinsurer and insurer at Lloyd's? And the thing that combines the two organisations is our shared view of the combination of underwriting and claims expertise, and our use of data and insights and automation. So ERS quotes on several 100,000 quotes per day, and we do that in under a second. What we think is that the future of some of those property and specialty risks for IQ will become more commoditized, and they're going to need to be rated in real time too. So ERS will become the platform and the blueprint for what IQ needs to become in the future. So it's that shared use of, that shared and combined view of underwriting expertise combined with data and automation that brings these two organisations together. But what's important for us is that motor remains a really important part of the group. So just under 40% of the total premium, that $1.3 billion, is aligned to motor, and that will probably flex over time and over the years, but motor will remain an important part of the group. So this year has been an incredibly busy year for ERS. We've never been busier. We've had over 100 million quotes to the business so far this year, which is a phenomenal amount of new business opportunities to ERS. Of that, we've seen around 100,000 quotes that are delivered either manually by your teams picking up the phone to our underwriter, or manually input via e-trade. So we've been fortunate. The investments we've made over the last few years in digital channels has enabled us to cope with this demand, because otherwise I don't think we would have been able to respond as we have been able to, and be able to return quotes as we have over the last few years. But investment in digital channels has enabled us to be more and more efficient in our trading, and that's been really critical for us, because it's really important that we make the most use of our underwriters' time and make sure that we're not wasteful when with your teams too. So we're trying to be as efficient and dynamic as possible by using our one-time online channels. But what we do see, which gives a load of confidence, is that our commercial quote, proportion of commercial quotes are now mostly online. So 95% of our business for commercial products is now traded digitally via e-trade, which has given us a lot of confidence. That's enabled us to now, this year we've launched Prestige and Enthusiast products on e-trade too, which means that we can be more efficient in our trading in some of those new and different specialist products. We've also listened. We were asked through this year, or the back end of last year, to get some products onto Actuous and Applied. So we've launched ERS Car at the halfway point in the year. Car and Van both went live on Actuous and Applied, and they're trading really, really well. So we're glad that we're able to respond to the requests. And on the ERS Car product, we've begun to expand our appetite, move into that as more of a specialist niche and less vanilla appetites that we talked about a couple of years ago. So now we're beginning to rate on age groups as low as 17, and we're looking and underwriting drivers with more blemished driving records. So we're really be able to expand some of our appetites too. And we were able to do that because of some of the investments we've made over the last few years. So Data IQ is a platform that's a machine learning platform that, when we combine it with our underwriters, enable us to rate in real time. And that means that what we've seen over this year is pricing updates that get signed off in the morning are now live in the afternoon. And that's really important with the environment that we've seen this year, that we're able to respond to the market to make sure we get the right pricing to the right customer really, really quickly at the right time. Okay, so here's another piece of another tool that we started to use, and this enables us to track quote manipulation, which sounds quite one-sided, but actually what this really does is it enables us to make sure that you will see less defaults on your account. You'll see less poor quality risk, which means that your account will run better because of the tools that we're investing in on our side of the business. We still do the specialist stuff too. So, you know, the ERS was really built on being a specialist motor insurer. Coffee carts, combine harvesters, Batmobiles, you name it. And obviously the Gumball Rally, which we've been underwriting for a number of years now. We're really proud of the very small bit we do to make that event happen. So this year it went from Edinburgh to Montenegro. We caught up with the Gumballers going from Edinburgh down to London. We watched the team, met some fans, met some drivers, looked at some awesome cars, and Alan Bradbury. He did do some underwriting of those, some last minute underwriting when he wasn't talking to Gumballers. And this all enables us to deliver on our value proposition that we think we bring to you. So this is around, we're a specialist motor insurer. We're committed to motor only, broker only. We obviously only write A+ rated Lloyd's paper, and our teams are experts in underwriting those complex and specialist risks. And this is a tracker that we look at once or twice a year, which is a consideration score that we do with a third-party research company, which looks at brokers' consideration of where they will place their specialist motor risks. And we're still really delighted that we're the number one for your teams when they're looking to place a specialist risk. So nearly 40% of brokers think of us first, the complex and the weird and the wonderful. And that's our nearest competitor down there. They're yellow and start with an A, but we didn't put the logo on. So we're really proud that we're still thought of first to the difficult and complex. And we've been working hard to make sure that our entire service is not just around the consideration, it's making sure that our claim service and our underwriting performance delivers too. So we're pretty proud this year that we've got to 4.7 stars on Trustpilot. And given that insurance is often the last thing that you're going to give a positive review for, we're really, really proud that not only your clients, but also your teams are rating us highly for our service. So with that, I'm going to pass over to Martin, but I did want to say this year's been really difficult and complex for everybody to navigate. And we are thankful for all the support that you've given us through this year as we've kind of worked through a quite difficult market. So I'm going to pass over to Martin, but thanks for all your support through 2023. Okay.
Morning, everybody. So I was really going to sort of reflect on 2023 and then sort of look forward to 2024. I think 2023, probably for most insurers and brokers, is probably a year that nobody's really going to forget. I think if you look at, I say hindsight is an easy thing, but in a really soft trading environment, I think driven by the reductions that happened in on the back of COVID and then the whiplash reforms, the market didn't really correct quick enough. And then in claims inflation, it hit really hard. And if you look at the analysis from somebody like EY, then you end up with a combined operating ratio for the market of about 110% last year. And a market correction, when you get to them sort of results, you normally get a market correction. And it normally comes in a few ways, really, which is insurers either tighten their appetites, rates go up, or for those that haven't probably invested in the right capabilities over recent years, they struggle to see a way out and they exit the market. And you could fill a whole presentation with slides like this if anybody tracks the insurance press over the last year. It's been a bit never ending. In terms of the wider economy, there is some read across really, I guess. So UK inflation increased up to sort of 8%. And whilst it's not directly related to claims inflation, but in motor insurance, there are things like energy costs and wage inflation, which is driving up claims inflation for motor insurers. And another big impact for motor insurers is the cost of reinsurance, which last year most people tend to renew on the 1st of January is a really challenging renewal. Most people seeing increases of plus 20%, not being particularly unusual. And reinsurance for most motor insurers is probably the thing you spend your most amount of money on. So I'd say when that goes up, it does have a big impact in terms of overall profitability. Claims inflation, though, has really been the big topic for the last 18 months. So if I'm going to do a quick summary of some of the key drivers of this. First thing, the cost of accidental damage. So a lot less cars produced during the COVID period all around the world. Issues with then supply chains of cars, including computer chips on the back of the Ukraine war, pushing up second-hand car prices. So an average price of second-hand car going up from under 14,000 to over 18,000 over a very relatively short period of time. You are starting to see that sort of flatten off now and start to reduce. In a similar way, on third-party damage, the supply chain, driven partly by Brexit, partly by COVID, partly by Ukraine, of parts into repair cars. You think, well, why is that a big issue for motor insurers? Because the longer it takes to repair cars, the more that we have to pay for credit hire, and the more that adds on to claims costs as well. So this is a table that shows the average length of rental, how long does it take to repair a car? And if you go back to 2021, it was around 20 days. Sort of 2023, it got way up over 30 days. But you can see that starting to ease as well. But really a big impact in terms of driving up claims inflation for motor insurers. And the third thing that's pushed up prices is care costs. So when you get large injury claims, typically people who need quite a lot of care, sometimes 24-hour care, and they're unfortunately involved in really nasty and serious accidents, then the cost of that care has really gone up. A lot of people who carried out that care work exited the UK as a result of Brexit, or with very, very high employment levels in the UK, could find alternative accommodation at that labour rate, pushing up again the cost of large claims. And this has a direct impact onto the cost of reinsurance as well. The only sort of favourable movements, I think, in reducing costs is the frequency and severity reductions on the back of the whiplash reforms, but they've not been enough to counterbalance the pressures that we felt in terms of overall inflation. So when you add all this together, this is on an accident year basis. You'd say claims inflation around about 12% for 22, 8 to 10% for 23. But when you add in a starting point of the market, the core of 110%, then there's only one guaranteed impact, which is going to be rates are going to go up. In terms of rate increases, this is the confused or Willis Towers Watson index, which as you can see, 19% in the last quarter, 58% year on year. We're just talking to somebody just arrived earlier on saying we've never seen anything like it from a broking point of view, and probably from an insurer point of view, it's the quickest rise in rates we've seen for probably 20 odd years. Now, all markets move very differently, so it's very easy to see an index for private car insurance, but if you look at the breadth of products that we cover across our specialist areas, then they do move in different ways. They have different start points, and they also have different relative strengths of competition as well. So sort of in terms of the intermediated private car market, then not quite probably at 58%, but typically renewals are being invited at +30, +40 is not unusual at the moment. If you look at the high net worth market, +20 and increasing is definitely what we're seeing at the moment. The taxi market's been really slow to react to claims inflation, whilst it's moving up in the third quarter, probably +20, +25%. The market probably needs more. And fleet's really been building through the year, probably up to double-digit increases now, but there's actually still some way to go. And in a lot of the specialist classes that we cover, then you've seen some of our competitors in and out, invite renewals, not invite renewals, and that's also starting to drive up prices as well as the market starts to move up. In terms of 2024, in terms of what to expect, well, I think there's still quite a lot of turmoil out there. The impact of a lot of them exits of insurers has not really been seen yet, because actually, if you look at some of the exits, they don't really even start till the 1st of January next year. So there's quite a lot of business to be replaced throughout next year. We think we've navigated the market pretty well within ERS. If anybody saw the EY analysis a few weeks ago in terms of performance, we're probably of any meaningful size insurer, probably the second or third best loss ratios in the market, which gives you a good starting point to move into next year. So in terms of where do we think we are in terms of the cycle, this graph really shows, first line is claims inflation. So dark line is an index of claims inflation going back to 2020, and the red line is rate inflation. So unfortunately, in motor insurance, you can't turn back time. So whilst we reacted really quickly to claims inflation, in hindsight, the market probably didn't react quickly enough and hard enough. And actually, the rate of inflation was much higher than what we probably anticipated. But you can see over that period, Q2 to Q3 2023, that now rates have sort of caught up with claims inflation. But you need to complete that at full sort of annual cycle for there to be a correction for all customers. So if you look into 2024, I think claims inflation has started to settle down. Sort of accidental damage you can see in that second-hand car prices, the length of rental starting to come down, probably claims inflation more like a historic normal average of around 6%. Need to keep an eye on injury inflation. There's another review of the whiplash tariff due next year, and there is a review of the Ogden rate, which will impact large claims due again sort of in the first half of next year. Reinsurance rates, I would think reinsurers are sort of benefiting from the rate increase as well. They're getting more rate per exposure, and also probably with an outlook for a bit more positive review of Ogden rate, probably flat to marginal savings in reinsurance costs, and some optimism in investment income as well, which is a big factor for profitability for motor insurers. But if you look around, for anybody who's expecting lots of new capacity to come into motor insurance, I think it's pretty unlikely. In 2024, there's just better places to invest your money, I think, at the moment. And if you look at the uncertainty that exists in the underlying performance of most motor insurers. So looking in terms of rates for 2024, maybe you might see some reductions, probably perhaps in the direct and aggregator market as the year progresses. But in private car and the broker market, there's a lot of business to be replaced as renewals stop being invited from the 1st of January. So I think the first half of the year is probably a continuation of the second half of 2023, probably slowing down to match claims inflation maybe in the second half of the year. If you look at some of the other segments, certainly high net worth, I think the present trends, the rate increases are going to continue, certainly through the first half of this year. And Andy will talk about there's just a reduced number of insurers in that market. Taxis have been really slow to react. Needs to catch up. We think probably +20, +25 for the first half of the year at least, and double-digit increases for most of next year. Fleet again, a bit slow to react. Probably needs to catch up with double-digit increases, I think, for the majority of next year. And Chris will talk a little bit about that in a moment. And agriculture, probably a more stable market. We're pretty well established as the #1 sort of intermediated insurer in that market. Probably there's been a lot of exits that have already taken place, probably pre-2023. Probably expecting claims to be rate inflation probably to be slightly above claims inflation, but back to sort of historic norms. So I hope that gives you a bit of a flavour of what to expect. Good news for brokers if rates keep going up, I think, and probably good news for insurers as well. So I'm going to pass across to Scott, who's going to talk a little bit about the investments in digital trade.
Smash the place up in the process it is. Right, well, good morning. I'm going to start off and talk to you about our digital trading journey at ERS, and then I'll pass across to Alex. We started from a pretty humble position back in 2017. We had two products on software houses, both car and van, and it was in that time where you used to have to hand out rate updates to the software houses, 4, 6, 7, 8, 10, 12 weeks later. We would get our changes into the market, and since that point we've invested really heavily in our infrastructure and our products. So we now have 3 channels. We've got 3 products on software houses, 2 of which are integrated into aggregators. We've got 10 products on E-Trade. E-Trade, I'm sure everybody uses it, is our broker portal. You can quote, do MTAs, binds, renewals, pretty much everything on there. And 4 products on Peers, which is our APIs between broker systems and our own back-end systems as well. We made 3 significant enhancements to E-Trade, improving speed, functionality, access, and we've had some really good success though. We've got 100% of our non-standard retail business is traded digitally, 95% of our new business from a commercial point of view, over 60% of MTAs and renewals. And we've just launched Prestige and Enthusiast, but we've got 40% of our business traded through that platform. And we're doing that because we actually think being quick, speed to market is a big differentiator for both us and for you as brokers. It helps us win. And when business does refer, it frees our underwriters up to be able to focus on building the solutions, pricing and underwriting those risks in the best possible way. We're not stopping there. Alex is going to talk about 24 and 25.
Scott. So whilst we've made some great progress on our journey so far, we are continuously investing into the future of digital trade in ERS, and 2024 is no different. So next year we have some exciting initiatives lined up across 3 key areas: so products, functionality and platform. So starting with our products, we're going to be launching a taxi short-term cover. So we're investing into our infrastructure to be able to offer a greater variety of product offerings that are not just fixed to your standard 12-month policy terms. In 2024, we'll see the launch of our first offering, which will be a 28-day taxi policy. And once we've delivered this product, we will be looking to grow the portfolio even further with different policy term lengths and new products. And then next up, we have our courier and business car into software house. So we're going to be deploying these 2 more products onto software house in 2024, starting with courier, which will increase our distribution to the market for single vehicle risks, and then shortly followed by business car later in the year. And then lastly, for our products, we're very excited to be announcing that we're going to be looking at launching a small agricultural farmers plan product onto E-Trade in late 2024. And whilst this product will be transacted digitally, it will continue to be backed by our specialist underwriters. And then moving on to functionality. So plug into ERS or Peers, we'll see some key enhancements made to its capabilities next year. 2 key pieces of functionality, which will bring the platform more in line with the custom functionality seen when trading via software houses. We'll be delivering an override capability, which gives the ability to override premiums, allowing for interaction with real-time pricing and specialist referrals, and a document API. Moving on to E-Trade. So when it comes to our E-Trade platform, we'll constantly listen to the feedback that you, our brokers, give to us. We'll take this feedback on board, and as a result, we'll be delivering 4 key enhancements to the E-Trade platform at the end of Q1 next year. These enhancements are split into 2 key categories. So the first being improvements to how you can communicate with us. So I'll be adding a text box to all referred quotes and MTAs, and a document upload across all transaction types. And then next is improved overall functionality. So in 2024, we believe that we can reduce our referrals by over 10%, making it more efficient. And we are going to be hosting policy documents online for access 24/7, 7 days a week. This new functionality will improve the user journey, making the platform slicker, easier, more efficient for you all to use across all of our transactions. Moving on to platform overall, but still on the theme of E-Trade. Our goal for the platform is that all low complexity business is traded digitally through it. As we've mentioned before, 95% of our commercial new business is currently transacted in this way, so we are making progress towards achieving this goal. Although a majority of our commercial new business is traded digitally, only 60% of all of our other business is traded via e-trade, but we're looking to increase this on the 8th of January when all commercial non-complex MTAs and renewals will be transacted via e-trade alone. In addition to the commercial business that we trade, 40% of our bespoke and personal lines new business is also transacted through e-trade. And again, this is the figure that we're looking to increase into 2024 when we launch Prestige Quote and Buy, which Anna will give more information on in a short while. Finally, to advance our digital trading offerings within e-trade, we know that our front-end user interface does require a refresh, and we're committed to investing into that at the end of 2024. But in order for us to do that, we do require your support. So an e-trade survey will be sent around to all users in the coming weeks. We'd greatly appreciate if you could give us your honest feedback. This will enable us to redesign a platform that is efficient and sleek, making it easy for you to trade with us in the future. And just on a final note, digital trading is really important to us as a business, and we hope that this gives you a feel for how we're invested into our infrastructure and distribution channels into 2024 and onwards, making it more seamless than ever for you to be able to trade with us. I'm just going to pass over to Annie, who's going to talk to you about our Prestige product.
Thank you. So as Martin's already described, 23 concludes what's been an interesting year, both in the motor market as a whole, but also in the high net worth and enthusiast space, both of which have historically been consistent, stable markets. Across the year, we've seen capacity shrink for various reasons being changes to appetites, mergers, and more recently, exits. So Cover and Mark studies, to name a few. At the same time, we've also seen and heard of service issues across a number of our competitors. The other unexpected challenge this year has been the increase in high value theft. So thefts in general have been up 13% when compared against last year. But what we've seen, unlike previous years, is that this has been a shift towards higher value vehicles being stolen rather than the premium SUVs that we've seen in the past. So vehicles that have been stolen this year include Ferraris, Aston Martins, Rolls-Royce, Bentley and Porsche, to name a few. We've reacted to this trend. We believe our go-forward approach of aftermarket immobilisers has and will be successful for us in mitigating against this going forward. So despite this challenging landscape, we've worked really hard to be a consistent market with little or no change to appetite and no deterioration in our service. The outcome is that we've seen substantial growth this year, our premiums up by 30% and our vehicle counts up at the same time. This follows our increased efforts to win larger collections. 60% of our business is now made up of multi-vehicle policies, 26% of those are the collections of 4 or more vehicles. And we're really proud that within 6 short years of trading, we're now one of the top 3 high net worth motor insurers, which we've achieved through organic growth in that time. So before we look ahead to 24, I just wanted to give a bit of a reminder on what bespoke personal lines actually means to us. So it's made up of 4 key products. The first is our Prestige offering. So that's our high net worth proposition, caters for supercars, high net worth collections, and individuals in the sports and entertainment industries. Next up is Enthusiast. That includes classics, modified and imports, and kit cars, motorhomes, and lastly overseas, which is a small section of the book, but it's made up of short-term business for international clients. So we spent some time reflecting on our success this year, and we believe one of the key contributors to this has been both our service and our relationships. Both of these areas are really important for us, but we recognise that as we grow, they become increasingly difficult to maintain. Our priorities for next year are therefore based around maintaining service, and we aim to deliver this in 2 parts. The first being our speed of service. So in October, 93% of the quotes we have presented, we responded to within 5 hours. To enable this, we launched eTrade in February this year. For Prestige, this is a quote capture tool with quotes getting presented immediately to an underwriter for priority turnaround. We're now seeing a third of quotes coming through this way. The next step for Prestige is to launch quote and buy functionality, which will happen in the first half of 24. For Enthusiast and Motorhome, this is already quote and buy, and it refers directly into underwriters for the more complex cases. For this part of the business, we're already seeing 2/3 of our quotes coming via e-trade. It can also be used for obtaining a price for our MTAs and renewals. So the second part of our service delivery is based around people and relationships. So despite focusing on efficiency, we're also investing in our underwriting expertise and also our broker relationships. By the end of this year, we're going to have a team of 14 underwriters who are focused both on our regional distribution and also giving national support. This is going to ensure we're well equipped for next year and what we expect to be another year full of opportunity and growth. And finally, just looking forward to the future of bespoke personal lines. So we're a small and agile insurer, and as such, it's important to us that our products continue to align with the needs of our brokers and our customers. For this reason, in August, we launched 12 new product enhancements to better align our product in the market. So this included both increasing the limits on certain covers already in place, but also introducing new covers. So multiple loss excess waivers and chauffeur injury cover, to name a couple. Despite the product enhancements, one of our key strengths continues to be the ability to tailor our products up and down. So rather than assuming every customer wants to pay a premium to access the full product benefits, we actually tailor each policy to the individual client and their needs. For example, we can extend our comprehensive driving other cars to include all drivers, or we can remove certain benefits, such as agreed value when they're not important to the client. Alongside this, and finally, we continue to invest in our dedicated prestige claims and operations teams. Our aim is to make the quote and claims process as easy as possible for both our customers and for you as our brokers. All our handlers are product experts, and they understand vehicles and specialist requirements to support both at the point of quote and in the event of a claim. I'm going to now hand it.
Cheers. Right, so let's bring fleet to life then. So as Martin mentioned earlier on, as a business, we think we've navigated challenging conditions pretty well. Fleet is no different. We're likely to end the year around 150 million, covering close to 140,000 vehicles. The underwriting team is 25 strong. It's handled somewhere close to or maybe more than 6,000 policies and over 22,000 quote requests. And as a reminder, fleet is made up of 5 core products. Risks range from family run through to corporate customers, and we cover an array of different vehicle types. So market conditions, how to describe these? It's certainly tough. Let's start there. So, and I'm sure there's more to come. No one is exempt from all the things that you've heard earlier on, but the most important bit is how would you deal with it? So what I'm going to go on to now is why we believe our customer base is growing. So from an appetite point, first and foremost, we know what we're good at, and we don't work on cold during market cycles. From a pricing perspective, we remain realistic and disciplined. And service, we know access to underwriters is key. However, the market dislocation is sort of really taking its toll. We're seeing a lot of extra demand. To combat that, we're active in the recruitment space, but anybody that's doing that themselves knows how difficult that is at the moment. But recruitment isn't just the answer. So to explain what you're looking at here, so along the bottom is a time series that's year to date. The solid red line is looking at quote requests, how that's sort of moved over the year. And then the pale line is looking at quotes into the market. So from a quote request point of view, this is 23% up year on year. So we are getting a lot more inquiries. However, the quotes to market has only increased 5%. So there's clearly some waste in there. I'm going to focus on the void. So the void is made up of many reasons. The most influential within there are things like can't compete. So this is where we believe we're more than 20% out from the market rate. Poor claims experience, those erratic risks, and free insurers in 3 years, or the serial movers, if you like. But a large proportion here, 33%, are risks that are outside of appetite. So I suppose bluntly put, risks we don't want. So the quality of risk heading into the top of our hopper have got worse, and it hurts. So all risks pass through an underwriter. So not only is it more costly, but it negatively impacts our service. And we now find ourselves in a place where actually we're not getting around to about 8% of the inquiries we receive, which clearly we're not happy about. So I suppose sort of looking ahead, the same sort of 3 bits are really important. So from a service point of view, we're going to continue to invest in our people and our data capabilities and prioritise where we spend our time. Price point of view, more of the same, so realistic and disciplined. And lastly, appetite. There's no changes here. We know what works, so please know our appetite to help us to help you. Thank you. I'm going to pass over to me.
Thank you, Chris. Lots of familiar faces in the room here today, and that's not just my ERS colleagues. Now, for those that don't know me, I'm Ming Wan. I'm the new business manager at ERS. Now, there's a lot of great content shared by the team this morning around market conditions, about inflation, about digital journey, and about building relationships. But I just want people just to take a moment to focus their mind on one theme which has come through really, really strongly amongst all different segments that have been presented, and that's about the dislocation and the volatility that pretty much everybody experienced during the course of 2023. Now, with that, I have a really, really simple message for you all today, and that is, at ERS, we're open for business. So it's a really, really simple message, but I think it's a simple message that's just worth restating at this moment in time, because most people in the room and many people who have dialed in online today have experienced a lot of challenge during the course of this particular year. Now, so what does that actually mean when we say that we're open for business? So firstly, we're offering quotes for new business for which that are in our appetite. We're offering renewal terms for our existing policyholders. Now, those things are things that we all take for granted, really. You know, we expect our insurer panel members to be able to offer new business quote, offer renewal terms, but actually, many insurers on your panel have probably failed to deliver on those two fundamentals during the course of this year. So we've also got, you know, a sales team covering every part of the country. Now, they're in your offices having meetings. They're working with you virtually, digitally, having lunch with you, having a drink, really to understand the challenges that you're all facing and understanding how we can shape and support you as you go through this particular journey. Now, over the last 18 months, we've created 7 new roles in our sales and marketing team to really deepen those existing relationships and also reach out to more than 1,400 brokers that we've got agencies with. And to date, we've carried out around about 3,500 broker meetings, so we're spending a lot of time with all our broker partners. And as you can see here, you know, we've got a really diverse portfolio of specialist broker products that are available to you all, ranging from classic cars, kit cars, high net worth collections, fleet, courier, agriculture vehicles, and many, many, many more. Many of these products can be traded digitally through your software house, through the E-Trade platform, which essentially means that you can quote on demand to your customers. You can do this in your office, at home, and on the weekend if you wish to do so. Now, for those risks that require more specialist underwriting, we've got underwriters who are empowered to make decisions. They want to trade with you. They want to speak to you. They want to understand exactly what the requirements are and create the best available solution to you and your customers. What we have seen during 2023 is an unprecedented number of schemes and advantage opportunities coming out to the market. And this is really a direct result of the dislocation that we talked about earlier on. Now, typically, these are long-standing arrangements that have a niche and also some scale attached to it. That requires something a little bit more bespoke and a little bit more tailoring. Now, with such opportunities, we've been able to kind of assess these opportunities quickly, deploy our team, and successfully on board within the time frame for the right opportunity. Now, a good example of that happened fairly recently. A broker came to us at the start of September and said, we've got an existing scheme that has been going for a number of years, and the incumbent does not want to continue that scheme beyond November. So essentially, they had 6.5 weeks to find a new insurer to take on that scheme. The good news is we were able to deliver on that, but between the initial conversation and actually going live, there's a lot of stuff that we collectively have to do. We have to analyse the opportunity. We need to assess the data. We need to create a bespoke policy wording, agree additional covers. We also need to test it just to make sure it's all works ahead of going live. So a lot of work went into that opportunity. And pleased to say, we were able to onboard that within 21 days. So we've got the capability to move quickly for the right opportunity. In the second half of this year alone, we've successfully secured over £40 million of these types of opportunities. And we've got many, many more in our pipe that we're looking to onboard in the early 2024. We're providing a really kind of safe and secure home for your businesses. Your scheme is really important for you, and it's the right time to be talking to an A-rated insurer about these particular opportunities. A broker, they're not just talking to us about books of businesses that they have to move. They talk to us about other lines of business that they've got that have got no immediate pressure to move. And why are they doing that? Because they want to insulate themselves from some of the volatility that we can expect in the early part of 2024 as well. Now, I accept, we see lots and lots of opportunities, and we can't offer a solution for every single one of them because we need to remain disciplined, we need to remain consistent, we also need to be profitable at the end of it as well. But my commitment and team commitment to yourselves is that if we can't offer a solution to an opportunity, we'll give you the rationale, we'll give you the thought process in terms of how we reach that particular decision. So just to recap, at ERS, we're open for business. And if there's any opportunities that you want us to talk to us about, please reach out to myself or a member of the sales team as well. Thank you.
Thanks, mate. So just really sort of summarise, really. I think really 2024 is still going to present some challenges. I think the first half in many classes is going to be a continuation of what we saw in the second half of 2023. We think we've sort of navigated relatively pretty well through the last few years. Last year was our 5th year consecutive underwriting profit. We think we're an insurer that you can rely on. We've got a clear identity and strategy. We see ourselves as a leading specialist motor insurer committed to the broker-only distribution channel. Now, I think importantly, with GBP sort of over 450 million next year, we've got the scale with some supportive owners to keep investing. We're really clear where we are investing. It's very much aligned to our strategy. It's pricing capability, more digital trading, supported by strong specialist underwriters with the ability to consider the more unusual risks. We want to be there to continue to support you. I think that one of the key messages hopefully today is please trade as efficiently as you possibly can. Utilise the training that we provide, the webinars, understand the products, trade digitally when you can, try and send us quotes that are in appetite when you can. And I think if we can get that collectively to work together, then we should be in a really good position for 2024. As always, thank you for your support. Happy to open for any questions here, or if you've got any questions that have come in online.
Do we have any questions in the room? Who's brave enough today? Anyone? I've got a few online. That's hopefully it might warm you up. Martin, I think you can probably take this one. Can you talk to a little bit about ERS's appetite for electric vehicles? Switch off when you're switch off when you're.
All right, better. Okay, good job with a lot of voice. Well, I think there's quite a lot of articles in the press about electric vehicles. I think the more and more everyone starts to understand them, the more you realise that they are clearly much more expensive to repair. I think what we've done so far is moved into some of the more specialist areas quite comfortably. So we have an appetite to write the electric vehicles in taxis, in supercars, where they appear in agriculture books, etc. as well. We're not a mainstream car insurer, so actually in our standard car book, you won't see us writing loads of Teslas and standard electric vehicles, but if the risk has got a non-standard element and that customer happens to drive an electric car, then we're happy to consider it. Obviously, a lot of our book is classic cars, modified cars, and not probably people who are not that keen on electric vehicles. But I think it's trying to find the balance as well. So that anything that's been modified, anything that's especially classes, we are keen to look at. I think the knock-on effect is clearly it is a driver of claims costs. So from a third-party damage point of view, if you hit an electric car, it still drives up the cost. They do cost more to repair, and we need to factor that into our prices as well.
Another one, I'm afraid, as well. You talked a little bit about reinsurance. What's your prediction for the market?
Well, if anybody's been involved in the reinsurance renewal market, it's all due on the 1st of, or probably 75 to 85% of the market's due on the 1st of January. And everybody sets off with the best plans to get all the quotes in and decide by the end of November. And we still haven't received any quotes. So it's gone back to normal form, which is sort of the last into December really is the time where we get decisions get made. I think the interesting thing is rates have gone up a lot in the market, and reinsurers benefit from that. So actually, whilst you see rate inflation being driven up by accidental damage costs and third-party damage costs, actually the reinsurers are really paying large injury claims, and that the inflation on large injury claims is much lower than the inflation on accidental damage and third-party damage claims. So they're receiving some benefit from the rate increases. I think the question for us is, will that rate increases get passed on to insurers? And ultimately, depending whether it does or not, makes you decide at what level do you buy. If you think you're getting better value in some of the lower retention layers, then we may take more risk on ourselves if we think there's not enough value in them layers. So that's the decision that will take place, I guess, over the next couple of weeks, really. I would say on average, probably flat to marginal reductions, depending how optimistic reinsurers take a view on the Ogden rate, but probably more likely to be next year's renewal as opposed to this year's renewal, where you see a lot of benefit from that coming through.
Thank you. And similar question on Ogden. I know you mentioned it earlier. Any thoughts on what will happen?
No, I think if most of the so I mean, Ogden rate is a factor that helps calculate the cost of large injury claims. It's related to the value that you get from investments when people are awarded large awards for injury. I think that if most of the analysis would say at the moment it's at -0.25, that the expectation is that it will become positive, maybe to plus 0.75 or to 1. And if that was to be the case, then that will have an impact on reinsurers. But the consultations undergoing. I think Deputy I had a claim submitted last night saying there's another level of questioning and investigation being undertaken, which is going to take another 12 weeks. So there's going to be some time into the first half of the year before we get any certainty on that.
Great. Is any brave souls left in the building in here who want to ask a question to anyone who's spoken? No, that's it. Right, thank you. We will make the recording available to anybody who's been here or has joined online, so you can share it with your teams. So we'll make that recording available either later today or tomorrow, so you get that on email. But thank you very much for joining us today.
Okay, cheers everybody. I think obviously there's some of the team here, there's some food. Make the most of trying to catch up with everybody. We're all going to be around for 7 hours or so anyway. So thanks for attending.